Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Justin Waine, Investment Director at Puma. Hello, Justin.
Good to be here.
First, can you just tell me a little bit about yourself and Puma?
Okay, I'm the Investment Director of the Puma AIM IHT service. I've been investing and analysing small and mid-cap stocks for nearly 20 years now. I joined Puma Investments back in 2014 to launch our AIM IHT service. In terms of who Puma are, we're the tax-efficient arm of Shore Capital Group, a listed UK finance company, and we cover a number of tax-efficient products, including AIM IHT, but also more capital preservation-based IHT solutions, and EIS and VCT.
So what's the purpose of the Puma AIM service? The
purpose of the service is twofold. The first is to deliver an AIM IHT inheritance tax mitigation through the use of business relief. So as many of your investors will know, for stocks that are listed on the AIM market, if you hold them for 2 years and are still holding them at the time of death, then you will be exempt from inheritance tax. So that's the first part of it. The second part of it is to actually deliver a good investment return to investors as well. So they get the benefit of both the tax break and an equity investment in small and mid cap.
There's quite a few of these services around the place. What's different about yours?
There's two things I'd really point to as being different. The first of all really is investment policy. We've got a very focused investment policy where we work through 3 different steps. The first is quality. We only look for good companies. So we buy good companies with high returns, strong margins and strong balance sheets. We're looking for companies that grow but that don't sort of necessarily blow the lights out in terms of growth. We're looking for companies that will be bigger 5 or 10 years from now. And the third part of that is valuation. As we say, we like companies that grow, but often companies that grow very fast are on very high valuations. So we're looking for companies that are sensibly priced, because with valuation, there's a price for everything, and we don't want to overpay. So that's the first sort of point, our core investment philosophy. The second point is actually being part of Shore Capital Group. Shore Capital Group is the 3rd largest market maker on the AIM market itself. It has numerous research analysts covering AIM companies, and that very much backs us up in terms of delivering a product to investors.
We've get lots of clients coming to us. They're interested in AIM services for obvious reasons. If they don't do it, they'll probably lose 40% of their investments to inheritance tax. But when it comes down to it, they actually don't do it because they think, oh my God, it's just too risky. How risky really is it?
It is riskier than investing in the FTSE 100, or probably is riskier than investing in the FTSE 100. But it is pretty similar to investing in small and mid-sized companies on the London Stock Exchange. The AIM market itself now is a £110 billion worth market, and we only invest in the companies above £50 million market cap. That's approximately 90% of the market by value. Now, the other part of risk is valuation, and as I said, we're very focused on making sure that the companies that we invest in are sensibly priced. So if you're going to go out and buy expensive companies, it doesn't matter whether you buy them on the AIM or if you buy them on the main market at the London Stock Exchange, or if you buy them in the United States, they're still not necessarily going to deliver you good returns if the growth that's expected doesn't come through. If you buy sensibly priced companies, as we do, at sensible valuations, you will get good returns, be you buying them on the AIM or if you're buying them on the main board of the London Stock Exchange.
And should investors worry that we're anywhere near the top of the market? Will this affect their portfolio?
I'm not a great believer in making market calls. Generally speaking, people who do make market calls don't really know what they're talking about, and the few that appear to be particularly prescient have usually predicted at least 10 of the last 2 bear markets. So as a general rule, I would take the view that it's very hard to predict the market. You're getting a potential tax break of up to 40% for your heirs, and if you buy a sensibly valued portfolio of stocks, then you will actually do pretty right over time. You do actually need to be able to ride out a little bit the ups and downs of the market. So if you are at all worried about volatility, then there are other IHT products that you can look at, though these obviously won't work terribly well with ISAs.
Could you just talk to me about a few of the companies you've got in the portfolio?
Well, we've been sort of a little bit contrarian compared to many AIM services, which tend to be seen to buy the very high growth, very exciting companies. We've actually been buying sort of very UK-centric companies, which I suppose is pretty controversial now. we're in this sort of Brexit and everyone's worrying about the UK economy. What it does mean is that we'll be able to buy up some very cheap companies. Now, they're a really exciting industry. So we've been buying a company called Epwin, which is actually a manufacturer of window components. So that's the kind of thing to get people really excited. But when you buy a company like that, you're buying it on 7 times earnings with a 5% dividend yield, producing loads of cash. That's the kind of business we like to invest in. And people have got to, at the end of the day, replace the windows in their houses. The housing stock in the UK is getting older. There will be a replacement flow that comes through. And other companies that we found in that area, a company like, for example, Waine, again, very exciting area of specialist construction. It's actually grown very strongly over a number of years, but that's a company which is very UK-centric. So you can get it on a very low single-digit valuation. And these companies aren't small. They're sort of 50 to 150 million pound market cap companies. So they are companies you can trade in and out of. What we would tend to avoid is these very high growth companies trading on very high multiples. Because while some of those will justify it, the vast majority won't.
There's a feeling in some quarters that there's a bit of an AIM bubble as a result of IHT. What would you say to that? I don't think that's an entirely valid argument. The way I would look at it is that there are a number of stocks at the top end of the AIM which are on very high valuations. I think those are on very high valuations because, generally speaking, growth stocks worldwide have been placed on very high valuations. I think there are, where they are owned by AIM IHT services, that may have given them a little extra push, but it isn't the main factor. There are plenty of companies, as I've said, that are qualifying for business property relief, which you can pick up for single-digit earnings multiples, where you can buy them with good, strong dividend yields and build a very interesting portfolio of stocks. So I don't think there is a bubble, though I think that obviously the inflows of money that are coming into the AIM for IHT purposes may be helping push up some already existingly expensive stocks. What I would also say is there is one difference to bear in mind, which is everyone talks about the money coming into the AIM market, but we don't have tracker funds. So there's plenty of money going into tracker funds that is pushing up the main market, be it here or in other countries. So that's one difference. For us, AIM IHT money, we feel fills that core sort of tracker function, if you like, within the AIM market. I'd like my parents to shield a bit of money from IHT. Why should they invest with you?
Well, as I said, I think there's 3 really good reasons why you should invest with us. The first is investment policy. So we have this distinct investment policy focused on quality, growth and valuation. There's plenty of people out there who are buying quality stocks on the AIM, but not looking so much at the growth and the valuation. There's plenty of people out there who are buying growth stocks on AIM, but not really looking at all at the valuation. So we're capturing all 3 of those. The second thing which we do is a bit different from other players in the market, is we're very numbers driven. Now, we do all our own spreadsheets, we do all our own models, we develop our own estimates and we come to our own price targets. That's very different from a number of our peers who are probably more dependent on the broking community to provide them with that kind of service. So when we come and look at companies, we have actually got a good strong position from our own base to look at. And that works very nicely with us in terms of selling discipline and stuff. So we know that when a company has reached fair value based on our own numbers, that we can sell out and replace it with something else. And the third factor I'd really point to is really our relationship with Shore Capital. We're part of an established financial business listed on the London Stock Exchange with a market cap north of £15 million and a strong stockbroking presence, which acts as support for us when we're looking at investing in the AIM stock market, in the AIM market.
Justin Waine, Puma Investments, thank you very much.
Thank you very much.